Hey guys, welcome back to the Investors Podcast new YouTube mini series where I'll break down our ultimate guide to stock investing to teach you the best tactics for building wealth over time. Hi, I'm Shawn, and this channel is all about the principles of investing. From stock tips to iconic billionaires, the best strategies, and our favorite tools, the Investors Podcast has everything you need to know. In this first video, we'll explore the benefits of investing in stocks in the first place, what types of accounts you can use to boost your returns, and the differences in active versus passive investing styles. Getting started is often the hardest part in investing, as stocks may invoke flashy Wall Street depictions that seem daunting. However, with this series, you'll learn what's necessary to not just beat the pros, but how to build a better financial future. You might find it surprising to learn that your investment performance will typically correlate less with your mastery of financial markets and more so with merely sticking to a principled plan over time. As legendary investor Warren Buffett has said, quote, "The most important quality for an investor is temperament, not intellect." So let's get started. The stock market has been the best tool in lasting wealth creation for generations of investors. The first thing to understand is that your goal should be to compound your money over time. So, what is compound interest then? It's a mathematical principle so effective that Albert Einstein called it the eighth wonder of the world. The idea is that by investing your money in growing and profitable companies, you'll see the value of these holdings correspondingly increase. As a shareholder in profitable companies, you'll routinely receive cash dividend payments that can be reinvested in buying more ownership shares of the business. This effect allows you to compound your wealth since you'll earn increasingly larger cash dividends with more shares. If that already sounds a bit technical, let the great Benjamin Franklin break down the concept more simply. Quote, "Money makes money, and the money that money makes money." All you really need to know is that if you consistently buy stock in great businesses and hold those stocks for many years, the rest will take care of itself. It's not rocket science, but it's the absolute key to investing well. Before diving into stock picking mechanics, let's review the various tools available for maximizing your compound interest. The simplest and arguably best approach to investing is through participating in a 401k plan. 401ks are retirement plans sponsored by employers that allow you to contribute part of your salary towards tax-advantaged investments, and it's an amazing tool for saving money. See our chart here for the differences between tax-free growth in your investments relative to taxable growth. Basically, if you use a 401k, the government won't charge you taxes on your profits so long as you wait until at least the age of 59 and a half to begin withdrawals. As of 2022, you can contribute up to $20,500 per year to a 401k, but beyond the tax benefits, the employer match is a feature that is quite common and valuable. Per Fidelity, the average employer contribution rate as a percentage of salary in the US is 4.7%, or $1,780 in total. This is a guaranteed 100% return on your investment up to the point that the match ends without any risk. By not participating, you may be missing out on thousands of dollars towards your retirement every year. Whether you currently have a 401k plan or have access to one in the future, understanding the two types is crucial. Roth plans are known as post-tax, meaning that contributions are not deducted from your taxable income today, so your tax bill will be higher at present. Traditional plans defer this tax liability, so they're referred to as being pre-tax because their contributions are deducted from your taxable income, leaving you with a lower tax bill today, but a potentially larger one in the future. So if you're young and anticipate your income to continue growing in the future, it'll be best to utilize a Roth 401k, which enables you to pay your taxes today based on a lower income and therefore lower tax rate while receiving payouts in retirement tax-free. For higher income earners who expect to make or live off less in retirement than you do today, a traditional plan is preferable so that you can defer tax payments on the money withdrawn until retirement when your taxable income is lower. Another great savings tool are individual retirement accounts, also known as IRAs. In 2022, the annual contribution limit is set at $6,000. Unfortunately, for high income earners, you may be ineligible to use Roth IRAs, though traditional ones are still available to you. If you don't have access to a 401k plan, an IRA, either traditional or Roth, represents your best tool for retirement savings, so contribute up to the limit if you can. So why would someone want to contribute to an IRA instead of solely sticking with a 401k? Well, in an ideal world, you would maximize contributions to both your 401k and an IRA at the same time. A noticeable difference between IRAs and 401k plans, though, is that you'll have more flexibility in choosing your investments in an IRA, as employer-sponsored plans tend to confine you to a few preset allocations. For some, the stock-picking freedom associated with an IRA will be an exciting opportunity to try your hand at, while for others it'll be quite intimidating. With that in mind, if you'll be picking any of your own investments, let's discuss the two main philosophies for doing this. There are two main approaches to stock investing, and the sides are split between active and passive styles. Passive investing methods are simpler, as investors choose to allocate money to index funds that are broadly based and defined by fundamental rules. For example, a passive investor may choose to invest in a mutual fund or ETF, also known as an exchange-traded fund, that holds all publicly traded companies in the US. This would be a type of index fund, and the advantage is that you now own a small slice of every American stock without making any specific bets. Not so bad, huh? Active investing requires investors to make well-researched or algorithmic stock bets. The S&P 500's performance is their benchmark to beat here. This index is arguably the most famous since it represents the returns of approximately the largest 500 US public companies. And from hedge fund managers to amateur stock enthusiasts, these active investors frequently design unique tactics to beat the stock market averages. Under the passive methodology, your wealth grows as America's best companies grow, and you'll avoid putting all your eggs in one basket. For most people, this is the best approach to stock investing, with a combination of index funds capturing the US and international markets. And the fees for doing so are extremely low, with many funds offered by Vanguard having fees less than 0.1 or 0.2%. The amount you pay in fees is solely up to you, so don't get tripped up by a product that sounds sophisticated, but in reality is eating away at your wealth compounding over many years. See our chart here for how high fees can hinder returns over time. And Warren Buffett famously bet on the superiority of passive investing once, challenging the entire hedge fund industry to outperform the S&P 500. Surely this is a task that the most esteemed investors on Wall Street can achieve, right? Well, surprisingly, no. Protege Partners LLC entered into a $1 million charitable wager with Buffett, selecting 5 hedge funds that from 2008 to 2017 they expected to perform better than the market benchmark. Despite the crash from the Great Recession, the S&P 500 index fund dominated with returns of 85.4% versus the 22% hedge fund average. Despite skilled management, robust trading systems, and advanced algorithms, simply buying the market was a much better decision for you than these hedge funds. That's it for this video, guys. Thanks for watching, and let us know down in the comments what you learned. Are you an active or passive investor? Just a reminder, nothing in this video is financial advice, and this is just intended for entertainment purposes. If you want to read our full guide on investing, check out the links below, and make sure to watch our book reviews covering our lessons from some of the best books on business and life. See you all in the next video. Look for bargain companies with a price to earnings ratio less than 25. This ratio captures the underlying income relative to a current share price.